Thank you so much, Diana. Good day, everybody, depending again on where you are. Thank you for joining us today for our webinar on Are You a Canadian Expat? How do you get a mortgage in Canada? So joining me today is Morgan Engelbretson and Wayne Buick. So Morgan is an independent mortgage broker with Mortgage Architects. Morgan splits his time between Montreal and London, UK. He brings a global perspective to the mortgage process. As an independent broker, he specializes in navigating the unique challenges that Canadian expats face when buying or refinancing property in Canada. Since 2020, he has connected clients with a range of lenders who understand the needs of Canadians living abroad, which is actually a very rare advantage in Canada's mortgage landscape. Mortgage will shed some light on how people can purchase real estate in Canada. As I mentioned earlier, we also have Wayne Buick, Managing Director of Trowbridge Professional Corporation. Wayne is a Canadian and US tax professional with CPA designations in both countries. He's presented personally on Canadian tax matters in the GCC for every year since 2006. He specializes in helping Canadians move to the region and individuals moving back to Canada. So Wayne today will demystify the rental filing requirements for non-residents who own property in Canada. And just to give you a little bit of background about myself, I started my career at TD in the commercial mortgage department and then did mortgage-backed securities. So this is a topic that is very near and dear to my heart. So I'm very glad to be moderating today. So Morgan, why don't we start with you? Me having started my career as a traditional lender, people have come to me to request mortgages. So I would love to know more about your role as a mortgage broker. What exactly does a mortgage broker do, and how does your role come into all of this?
Yeah, well, thank you, Minu, and thank you everybody for being here today. I also find mortgages quite exciting to talk about, and definitely in my experience, if you're an expat, getting a mortgage in Canada can be challenging, to put it lightly. So I appreciate everyone being here so we can talk about the topic. To start, often I find there's some confusion about what a mortgage broker is, and you mentioned, Minu, I'm an independent mortgage broker. And what that means is that I am not affiliated to any particular lender, right? So I don't work for the lender. And it's an important distinction because when you call whichever lender you're speaking to, you're going to speak to a banker, typically, hopefully, professional, courteous, knowledgeable about their products, but they represent their employer and the best interests of their employer. Whereas a mortgage broker, we're kind of sort of on the other side of things because we're not employed by the lender. We represent you towards or facing the lender, right? So our bias is that we want to figure out what sort of how we can make this work and how best to do it for you, facing the lender. So just it's a small distinction, but it's important to understand where our role sits, right? Really as a representative. And one thing I always like to explain to people, because it's the follow-up question I typically get the most, is how do we get paid, or how do our services work, right? And which is a really important and fair question, because you don't want to be 3 meetings and 25 documents later thinking, how much is my bill going to be? And so as a mortgage broker, the way that it works is pretty simple. If you don't work with a mortgage broker, right, you go directly to the bank. The bank is spending money, right? They spent money on the advertisements so that you think of them. They spent money on the support staff and the buildings and the salaries. And especially in the case of an expat, how many people would the bank need to meet before somebody even qualifies for a mortgage? Of those who qualify, how many of those end up accepted in Canada? And so you can think of it like it's a traditional cost of acquiring a new client, right? Just like any business, you have to spend a certain amount of money to get a client. Whereas when you work with a mortgage broker like myself, the bank is not spending any money in the sense that we are doing the work. We're reviewing documents, we're discussing strategy, we're looking at the different ducks in a row. We basically have a finished product, if you will. We then present that finished product to the lender. And then because the lender didn't have to spend all of that time and money finding you, they pay me a commission. So my services to you are at no cost. And the bank is happy also because they didn't have to do all the sort of rigmarole of trying to hopefully find a client. So that's kind of like, in a nutshell, how it works on the brokerage side.
Understood. And so, do you typically only work with traditional bank lenders? Do you also work with other lenders?
Yeah, good question. So there are basically there are three tiers of lending in Canada. We have A lending, B lending, and then private lending. In the world of A lending, we have two kinds of lenders. We have traditional lenders. These are lenders that have brick and mortar locations. They sell credit cards and lines of credits and car loans and so on. And then we have what are called monoline or virtual lenders, which are lenders that only do mortgages. They don't do anything else, so they don't sell credit cards or car loans. So I work with both of those. Um, and then underneath that, underneath the A lending, which is what people I think most associate with mortgages, right? When they think about a bank, they think about TD Bank or Scotia Bank or whoever. Those are going to be A lenders. Then right below them, you're going to have what are called B lenders. B lenders are lenders that specialize and typically more complex or difficult credit situations, people that have poor credit or there's something not quite great with their file typically, or in Canada, you're self-employed, often you'll go through the lending route, higher costs to do business with a B lender. And then you have private lenders. And private lenders are quite literally what the name implies, which they're lenders, they're people or companies that lend out their funds to make your mortgage happen, right? And that's sort of like a very broad array of types of lenders in that space. So I work with all three levels and with all types of lenders.
Okay, great. So, if someone has a little more of a complex request, you could still serve them versus
Yeah,
a traditional lender may not be able to. So, it would
yeah,
benefit the people to come to you for advice. Understood.
yeah.
Got it. So it's been a while since I've worked in mortgages in Canada. So I would love to get, just understand what's changed. So is it possible now for a Canadian living abroad to get a mortgage in Canada?
Yes, the short answer is yes, it is possible. Um, there are some requirements that are different in comparison to a Canadian who is living in Canada and getting a mortgage there. The broad lines, obviously, everybody's file is going to be unique, and we're always going to look at it through that unique lens. But here to just speak broadly. It's possible. We're in the A lending tier typically, so we're not going for a B or a private lender, so we're qualifying under normal interest rates and so on. So that's a big advantage. Um, the first thing is that we need to put 35% down payment. To contrast that, if you were buying, for example, an investment property in Canada, you would have to put a minimum of 20% down payment. Now, here, and this is one of the big advantages, depending on where you are working in the world, is that if you have either, for example, in the UAE, a lower tax environment, or you're working in an area that has a currency advantage, putting a little bit more down payment may not feel so bad in comparison to someone who had been living in Canada. So that's the first requirement is 35% down. The second requirement is that you need to be employed by a company and it cannot be your own company. So you need to be a full-time employee somewhere. So that's an important one in the A lending space. And so you need to be full-time employed. And then the last thing, which this one typically doesn't cause a problem, but because you don't have credit history in Canada or you have a more limited credit history in Canada, we need to basically create a credit profile for you. And so what we do is normally we'll show 12 months of account statements along with 12 months of various bill payments to say, look, we don't have a credit score in Canada, but here we can clearly see that the cell phone and the heating bill and the insurance bill, here's the bill and here's it coming out of the account. Clearly, we have a habit of paying our credit on time. So basically, those are like the three big lines, right? We need to create credit, we need to have enough down payment, and we need to have income that we can prove.
Okay. Would a UAE credit bureau report help at all in this case, or?
So, the answer is yes. The
Okay.
UAE or any credit bureau outside of Canada, it doesn't matter where it's from, will work in building that story. Right? So
Okay.
it's not that it's going to be taken one for one, that you use this credit in lieu of Canadian credit, but it will be added to the total risk, if you will, of the file. And then obviously every country has their own nuances, right, on how they calculate or if they even have a credit bureau. But yes, the short answer is absolutely anything to prove that we are credit worthy helps.
Right. And so, what
Yeah.
is the nuance for someone who would be self-employed, for instance? Is there a way to, to solve that problem solution?
So there could be, in my experience, self-employed is a first of all, it's a very broad range of what
Yeah.
that really means, right? So again, answering this question very broadly, each individual person we'd have to look at specifically, but you would no longer be in the A tier. You would
Mm,
most likely be in the B tier, but probably you would find yourself in the private lending space because then you'd have someone who has the most flexibility in understanding your situation. So it is possible. It will come at a higher cost for you. But then again, and this is what the discussion I have with people who are self-employed is you're probably self-employed for a reason and there's benefits for that. And so sometimes there's a cost on the other side of that, right? Famously in Canada, people who incorporate pay themselves a lower salary to pay less income tax. Well, conversely, they may be stuck paying a little bit more in interest because of that choice, right?
understood. Okay, that makes
Yeah,
sense.
yeah.
So moving on, what are some of the key differences between getting a mortgage while living abroad versus living in Canada? I think you highlighted some of it, but if there's anything else you wanted to add.
Yeah.
Okay.
Well,
Um, but I think one of the key differences is that CMHC would no longer
correct.
support, right? If I remember correctly, because that was a
That's
change that happened.
that's the big difference. So whenever you're getting an insured mortgage, meaning you're putting less than 20% down, um, you can only do that if it's your primary residence. And so right off the bat, because you're living abroad, this cannot be your primary residence, so it cannot be insured. And then you add to the fact that the CMHC doesn't consider income that is earned outside of Canada if it's not declared inside Canada. So I would say that's the major difference. And if I can, press this point because it is important. People often just assume if I can get a mortgage, it's going to be extremely expensive. To reiterate, if you fit those three criterias, the down payment, we can build a proof that your credit is good, and you have employment, then you're falling under the A lending tier, meaning that you're qualifying or you're getting the same interest rate as someone who had been living in Canada. The difference
Mm,
is the amount of down payment that you had to put. But other than that, it's the same products, right? So you're not getting penalized for living abroad. I think that probably the biggest challenge, and anyone who's watching this, who's ever tried to get a mortgage as an expat, is that because Canada has a foreign buyers ban, what happened
mhm,
is basically most banks have shut down their expat or international funding departments. And then the banks that do that funding, within them, it's a very reduced team of people. So you might even have called the correct bank that does this financing, but the person you spoke to, they don't know that this is still possible and has still told you no, right? Which I think, one of the advantages of working with someone like myself is that we're basically bypassing all of that, right? We're reviewing your situation and we're saying, okay, where does this fit? And then we're calling the correct people and saying, okay, this is what we have. Is there something that can be done?
Yeah, okay, understood. Okay, great.
Yeah.
And I think this may be a question for both yourself, Morgan, and Wayne as well. So, what are the tax implications for buying in Canada as an expat?
But that's a really great question to ask Wayne because there's something there are a few things I think Wayne can bring up that are important for people to know, both when buying and when owning and returning to Canada.
Okay, great.
Definitely. All right. Thanks, Mina. Thanks to Sangeeta and Diana and the CBC. Like I said, I first presented with the CBC in 2007. I've done it every year since, and really appreciate the support that you guys give to the Canadian community. And Morgan's a great addition as well. Um, so yeah, when looking at purchasing a property in Canada, there's a lot of different tax implications for sure. One, depends, are you subject to, the non-resident surtax? That's something to think about. What are you going to do with the property? Are you going to rent it out? If so, then there's tax implications there. But also, if you just leave it vacant, there's some tax implications there in regards to residency, or even vacant home taxes. So there's really just a lot of things to think about when purchasing a property. So.
Okay. So can someone leave their home vacant in Canada, and how would that affect their tax residency status? Because personally, me, when I left, I decided to sell my property. I didn't rent it out.
Okay.
And so it's just would love your thoughts on that, but I don't know if I'd made the right decision. So, what are your
Yeah, I
thoughts on
mean, there's a lot of things that go into that decision,
that?
but
Yeah.
like I love this answer. It's a classic accountant answer. It really depends, right?
Yeah.
So typically, if you're just first moving over, we would not recommend having a vacant home, right? Because
Right.
it's a major tie to Canada that could threaten your residency, right?
Right.
But if you've been abroad for 10 years and then you buy a vacation property and you just use it, in the summers, or if you've always had a vacation property, then it's different. So each scenario depends, but it's really important to make sure you talk to someone about that because the last thing you want to do is pay tax in Canada on your worldwide income, you know.
Correct. Yeah.
So that's a very important thing to think about. And there's also,
So
yeah, go on,
go
sorry.
ahead. No, no, go
No,
ahead. Sorry, sorry.
yeah, no, and there's also vacant home taxes, right, and things like that if you just leave a home empty. So there's just a lot of different things to think about when you have a property in Canada. So
Okay. So so that brings us to our next question. What is the biggest mistake you see with people when they have rental properties in Canada, and what are some of the pitfalls, right, of having them if it's not already been covered with the tax residency?
yeah, I mean, I think, one of the biggest mistakes and things we see is actually not getting professional help, right? Whether
Mhm.
it's, an accountant who specializes in, international tax, a mortgage broker who specializes in dealing with expats, whether it's wealth management, someone that deals with expats, not getting the proper advice, can lead to a lot of pitfalls. Some of the other things are just kind of not doing anything. We see sometimes people just don't even file. They think they're in a loss position, so they don't have to file. And there can be some significant penalties for not filing, even if you're in a loss position. So, yeah, those are kind of some of the things that, we see get people caught up with in regards to having properties. So.
So people actually, just so that I understand correctly, so people don't typically declare. There have been cases where people haven't declared the income on their tax return.
Yeah, so they think, well, you know what, I'm in a loss position on my rental, I'm losing money, so I don't owe any tax, so I don't have to file, things like that.
Ah, okay.
But there could be a 25% penalty on the gross rent of the property. So, if you're renting it for $2,000 a month, that could be a $500 a month penalty, which adds up to like $6,000 a year, even if you're in a loss. So, if people don't get the proper advice in advance or don't do anything, they can owe a lot of penalties. So I think
Got
that's
it.
so.
And so, are any of the expenses deductible? How is the income tax generally? And do people get a credit back? I remember from filing taxes a very long time ago. So, how does it work for the income taxes on rental properties?
Yeah, so that's a lot of misconception. Like if you have a rental property in Canada, you still have to file because it's considered Canadian income, you know.
Mm.
But on that tax return, the only thing you report is your rental income. And
Mm.
then and then you can write off all your expenses, like mortgage interest, property taxes, repairs, if you have a property manager, tax assistance, fees, and everything like that. So a lot of times there won't be any net income, right? But even if there is, because you don't have any other income, you're only taxed in the lowest tax bracket, which is about 20%. So it's really not it's not that bad, and you don't have to worry about your income in the UAE being taxed in Canada if you're a non-resident. It's just the Canadian income. So
Right, understood. So now we've bought a property, thanks to
yeah,
Morgan.
yeah,
We've rented it out.
yeah.
We've collected some rental income, and we're filing all our taxes on time. So if someone wanted to sell the property, what would be the best time to sell the property? Would it be before we decide to move back to Canada or after we move? And then how complicated is that process?
Okay. So to go back to my favorite answer, it depends. Um, and the reason it depends is sometimes it is better to sell as a non-resident, um, because then you have no other income, right? And so if you have a
Mm.
gain on the property when you sell it, it's taxed at a very low rate. Whereas if you go back to Canada and you're working, it gets added on to the top of your income. So, sometimes that's why the timing is easier. But if you do sell it as a non-resident, there's this painful process that you have to go through where you have to get like a clearance certificate, and initially 25% of the gross proceeds of the property are withheld. And so it is kind of a painful process. So each situation is really dependent on the facts. So again, it depends.
But I assume that if someone then decides to move back into that property would then turn into the principal residence, and then unless the laws have changed, I assume wouldn't be a capital gain anymore, right? When they sell it after it's a principal residence, is my understanding correct?
No,
No, my understanding is not correct. Please
no,
educate
no.
me.
Well, no, no. So it's partly correct. How about that?
Okay.
So what happens is, and this I get this question all the time. People are like, "Well, if I move back into the home and it becomes my principal residence, does the capital gain go away?" And the
Uh-huh.
answer is partly. But what happens is like if you rent a property for 10 years as a non-resident and then you move back into it and sell it, it's not like the whole gain goes away. You can start prorating it, like 1/11 years, 2/12 years, 3/13 years. So there's always still going to be some type of gain, but you can minimize the gain if you live in it for a long time afterwards. So
Okay.
so
Okay.
that's where, yeah, because you only get the principal residence exemption for years you live in it in Canada as a resident. So
Got it. Got it.
so
Um, so Morgan, just back to you, a couple more questions.
Yeah.
How long does the mortgage application process typically take? So is it lengthier for a non-resident? Is there more due diligence involved? So when should
Yeah.
people really start planning for all of this?
Well, that's a good double question, Minu. And so the answer, okay. So first, like all things, it's a two or multiple person team effort, right? So uh, depending on how quickly you were to send in the necessary documents will obviously dictate the speed of the transaction, right? So I have people who are, call me on a Monday and by Monday night, I've got all the documents. We're moving fairly quickly. So I would say the first thing that slows us down is that because we need to provide additional documents, mainly proving that we have good credit behavior, that first step slows down the process a little bit. Um, In terms of an actual mortgage application, it's a little bit longer because the bank is going to be doing more due diligence because the risk is going to be higher for them, but it's not monumentally longer, right? So if a normal mortgage approval takes, between 1.5 to 2 weeks, let's say, maybe an expat mortgage takes between 2 to 3 weeks. So that's not so onerous. Um, well, your first question, which I think is really the most important, which is when should we start? And often people will have this where they'll think, okay, well, I don't want to start until I'm ready to do something, but that's wrong. The moment we should start evaluating our capacity to get a mortgage or deal with whatever situation we have, should always be as soon as possible, because what we're doing in the first step is a fact-finding mission. We're not applying for a mortgage. We're not putting in a purchase agreement on something. We're not doing anything. We're only doing homework to determine what's possible. And so people find themselves in this situation where they do all of their mental planning, right? They've got all the pieces of the puzzle figured out, and they say, okay, now we just got to figure out the mortgage. And then it turns out the mortgage is not how they thought it was going to be. And so now all of the work they spent 6 months discussing with family and thinking about all this stuff all goes down the drain. So I would always recommend start first with, we often find ourselves like probably what I see the most common is someone wanting to buy a property because they're planning to retire and move back to Canada, or they have a
Mm,
family member that they would like to house in Canada. And so they're purchasing a property. And so those are two things that require some life planning to get to that stage. And so the sooner we actually figure out, can you qualify for a mortgage? How much can you qualify for? The easier everything else becomes, basically.
Yeah.
and would you recommend people do get a pre-approval before they decide to go shopping for a
Yes,
property?
always.
Still, yeah.
Always,
Um,
absolutely. Never go shopping without one. And sorry to interrupt there, especially when we're an expat, because the moment you want to make an offer and you have to disclose that you're not living in Canada, unless you have some document stating that this probably can happen, you're not going to be taken seriously.
Understood. And would
Yeah.
people have the option of both variable and fixed rate?
Yeah, absolutely.
All right.
Yeah,
Okay.
absolutely. And I like to think of it like the bank is a tool, right? And as a mortgage broker, my objective as a business owner myself is to form a long-term relationship with you, right? To be there to shepherd you or to guide you through this process, not just in the singular transaction, but over the next, 15, 20, 25 years, however long we have properties in Canada. And so with that question of, do we go fixed or variable? I always like to think we take a macro view of our situation. What are we trying to accomplish in the long term? And then where does this specific mortgage fall? And then we build out the mortgage in relation to what the plan is.
Okay. And just to give people an idea of what documents would you typically require? IDs, salary letter, credit bureau, anything,
Yeah.
utility bills? Yeah, those sorts.
Yeah,
Okay.
the standard package of documents is pretty straightforward. So, letter of employment or employment attestation or however your employer calls it. Normally, ideally, 2 years of income reports or proof of income. So depending on where you're located, maybe you get a payment statement or you get something, right? Saying this is how much I made last year, this is how much I made the year before. A pay stub, your most recent pay stub. And then, like you said, the 12 months, so 12 months of bank statements, 12 months of bills, so like 12 months of a cell phone bill and a utility bill. That would be sort of our standard package, along with two photo ID, right? We need to be able to confirm your identity.
Okay. Understood.
Yeah.
Perhaps we can turn to the audience for some questions, unless you gentlemen have some very last final words of wisdom before we turn to the audience for questions. Okay.
No, yeah.
All right. One second, let me just see if I can see the questions. So the chat's open for our participants. If you have any questions, please feel free to type it in there for us, and one of our lovely hosts would answer it for you.
Yeah. Well, there actually is a question here. It's from it says, what happens if you and your husband are both self-employed? The only problem is I don't know what happens if they're talking about, I guess they're trying to get a mortgage, I guess. And I'm sorry if the person that asked that question, if they'd be so kind, that would be great to tell us. I'm assuming is what happens if you and your husband uh, are self-employed. I guess is there a possibility to get a mortgage?
Yeah, so there is a possibility to get a mortgage if you're self-employed, but like I mentioned, we will no longer be in the A tier of lending. We are maybe in the B lending, but probably in the private lending space. So you can get a mortgage, but it's going to be more expensive. One thing that's important to mention, and this especially for people who are looking for vacation homes, is that once we fall out of the A lending, we now are in the B or the private lending. We typically want to be near large city centers. So sometimes we'll have a situation where people are self-employed looking for a cottage. That's going to be basically not impossible, but it's going to be very, very, very uh, difficult, near impossible to get that kind of a mortgage. But if you are both self-employed looking for a condo, in Toronto for a kid, there would be a possibility to do that, but we would probably be in the B or the private lending space. So it would come with additional costs. So interest rates would be higher. There would be some fees from the lender, but
I think the connection just froze there for a little
Yeah.
bit.
It did. I just saw
yeah, it
that.
froze there
Okay,
for
I
me
was
too.
like, okay, yeah. There's another question right after this. Sorry, we'll just have to find out. Yeah, sorry. There it says, yeah. What happens if you and your husband are both self-employed for a mortgage? What is the timeline for a mortgage? Similar as others or longer process? I think we touched some of that. We have a condo due
Yeah.
in January 2027 in Pickering, Ontario. Thank you.
Well, that's a great question. And to not steal Wayne's answer of it really depends. If we're talking about um, a mortgage renewal is different than getting a new mortgage. And here, it maybe is important to understand that if we are with our lender and our situation, um, okay, if we're with our current lender, we have the option to simply accept their renewal offer and keep going with obviously whatever the now new interest rates are, but with a new mortgage along the same file, if you will. That's probably in that case a lot easier or a lot better for that individual or those individuals than now trying to go and take that mortgage and bring it to a private lender, at three times the interest rate.
Well, actually that explains that very well. I actually have another question over here. It says, can you set up a type of trust if you wish to purchase a property as an expat for your children? Maybe that's a Wayne thing.
Well, maybe
Yeah,
if
go
I
on,
can
Morgan.
interject here, then Wayne can answer because I think technically you can. But finding a lender who is going to want, in this situation, to issue a mortgage for a property held in a trust, again, would be very difficult.
I guess on my end it depends. No. Like there's various ways you can do it without actually creating a trust. There's the concept of like a bare trust, which is you're not actually having a trust, but the children are like the beneficial owners. If that's what you wanted to do, sometimes we'll see people will have like a demand loan on a property. Well, they'll buy the property for the children, but sometimes, they don't want the children to potentially run away sell the house and run away with it. So there's a demand note against it. So there's various ways that you can structure it. But typically a trust would not, like an actual trust would not be the right way. Um, but of course, like there's so many different scenarios. So we'd look at it in more detail. So.
Fantastic. Okay, so they added on here in the Q&A, they added on with so if there's not a trust, do you have to do these things prior to the purchase, prior to the mortgage, or can that be done at any point?
I mean, ideally we set it up beforehand. But I've done probably two in the last week that are 8 to 10 years ago because it, that the the plan at the time was really for the children to be the owners of the home, but it just wasn't documented. So, you kind of put in the documentation now to support it. I mean, you can't backdate it, but you do put in some documentation now. So, I guess the answer is yes. So, but it's always better to do things in advance if possible. That's also things. Did I freeze now?
I was talking to myself. I said there's another
Okay.
question
I
in
was
the
like,
Q&A.
okay.
Sorry. Okay.
Yeah.
Okay. So there's a ton. Okay. If you are married to a non-Canadian,
Yep.
can you apply for a joint mortgage?
Yes.
If my husband is the one who's employed with a consistent salary, but is non-Canadian, and I'm the Canadian and the homemaker, can we jointly apply?
Yes. Yes. If you're married, you can both be on the mortgage and we can use both of your income and so on.
Well, you make these answers so simple. I was expecting longer answers. Okay, sorry, no. So that's why I turn my mic off all the time. Sorry about that. Okay. All right. So, so let's say, Minu, what do you think? Do you think they could come about? Maybe our two speakers could come with, let's say, 3 or 4 tidbits, like take-home answers for mortgages and take-home answers for what taxes around that would be in, so that we can sort of reorganize the discussion until other questions come in.
Sure. Yes. Would Morgan, if you want to go,
Yeah.
if you want to get started.
Sure. Well, actually, and maybe this is when you can jump in here because I mentioned this a little bit before, but maybe if Wayne could expand on what would be the best practices if people are under these two scenarios, which are the ones that I see the most commonly, which is first someone is buying a property to house either their children or their parents. Typically, I mean, it can be other family members, but that's typically what we'll see. Sort of what are the tax implications around that? And then the second scenario we see is, and this is probably the most, is that we purchase a property for the eventual retirement and move back to Canada. And so we're going to have a tenant in there for X amount of years, and then we're going to come back and it's going to be our primary residence. So what would be, Wayne, what would you say would be the sort of the tax prescription if we're doing that?
Yes. So, I mean, I think that again, I think that's sort of related to another question about trying to do as much documentation in advance, right? And so, if you purchase a property for your child or your mother or your parents, and you're on title, you can still set it up that the parents or the child are the beneficial owners and they can get the principal residence exemption and it
Yeah.
doesn't affect your residency status. But
Yeah.
there's certain things that you have to go through to make sure that works. So if you do that in advance, it's really good and it could save, a ton of money in the future and taxes and potential residency. So that's do that in advance and it's typically not a problem. So,
Yeah,
and
that's
then
good to know.
yeah. And that's why sometimes we see people have done that and they didn't realize, and then that's when we try to back document it, right? But it is a little bit harder because you haven't had a chance to plan. Retirement is, property is a little bit riskier per se, right? Like you don't want to risk, you don't want to say, you clearly show intention of coming back to Canada, right?
Mm.
Because, because you're not taxed in the UAE and you don't want to become taxable in Canada. So there is a little bit of risk. Maybe if you want to do that, you rent it out to make it not available for your use.
Yeah.
But a lot of times, I would look at the risk depending on how much money you're making and whether the time is right to purchase now or wait till you're closer to retiring.
Is
So,
there
I
is
think
there a general?
most people.
Sorry, go ahead.
So I was going to say, what I've seen most people in that scenario is rent out the property because they do want to actually cover the cost of purchasing that property for the period of time that they're not
yeah,
back in
and that makes
Canada.
sense on so many more levels as well, right? Taking away the risk, getting
Yeah.
costs covered, and so,
Yeah.
potentially avoiding vacant home taxes. So that's what I would recommend for sure. So.
Yeah.
Is there a general rule of thumb as to how long one should rent out the property so that people can start planning ahead before they want to go back to retirement to evidence that they haven't purchased the property for retirement? Is there anything around that at all, or?
No, I mean, this is where it's like everything is so gray. Like the
Yeah.
residency rules are just, there's no real set definition. It's all about intention and things like that. I generally say it's not really a risk, right? But because there's no tax in the UAE, although I'm going to say that eventually it's going to come. Like
Mm.
they have some corporate tax now there's like VAT. Like eventually we're going in that way. But because the tax rate is so differential, so it's such a big difference, I like minimizing any of the risk. So, you know, again, it's really case specific and such. So.
Is there anything else, Wayne, that that we should be considering as we are trying to repatriate and move back to Canada? Anything that we haven't covered today that stands out at all to you?
I mean, there's a ton of things about, when you get your last payments and a whole host of other things like that. But related to the properties, not really. Just I guess don't leave it empty too long because sometimes what'll happen is a renter will go leave, and then the person won't try to rent it again. And so depending on how long that period is, you might want to think about that. If you're doing renovations or things, that's something else. But yeah, those are the key things I think. So.
Okay. Martin, I'm not sure if you are able to answer this question for me, and if you're not able to, I will withdraw. But just wondering, any idea on just what the current interest rates in Canada are? Are you able to provide us with
Yeah.
just very
Yeah,
broad
absolutely.
strokes?
Absolutely. The rates are depending again on the term, the period of time that we have the mortgage, and if we're going for a fixed rate or a variable rate. Right now, on the fixed rate side, we're kind of in the low to mid 4%. And on the variable rates, we're in the low fours, sometimes high threes. Um, Sorry, just needed to sneeze there for a second. Poor timing. But yeah, somewhere sort of think of it like between 4 and 4.5, basically, depending on your situation and what you're looking to get. Um, Obviously, historically that's pretty good. Like if we're borrowing under 5%, I think we're doing good.
Mm. And this is a very a hot topic and a contentious question, but variable or fixed?
Oh, I love this question. So Yeah, because I think everyone, not everyone, people like to give some sort of prescription when it comes to this, and I'd like to flip it the other way around. So when it comes to your mortgage, there are things you know and there are things you don't know, right? Things you know are how much you're putting as a down payment, what payment frequency you're choosing, how many years you want to take to pay off the mortgage. Those are things that are concrete, that irrespective of interest rates, you can say, I'm going to pay this weekly or bi-weekly. I want to pay it in 20 years and 25 years. You have control over that. The things we don't know are the interest rates, right? We know what rates are today, but we don't know what they're going to be tomorrow. And so with that, what we're doing when we're getting an interest rate, right, whether it's a fixed rate or a variable rate, is we're taking a gamble, right? Because if we take a fixed rate, it's because we think that in the near term rates would increase and we would like to protect ourselves against that increase, but we don't know that. There's no way of us knowing that. And if we're taking a variable rate, there are two reasons why we would take a variable rate, but the main one being we think that interest rates will remain stable or decrease, or we want to minimize the penalty because we're planning on selling the property. And penalty is a whole different discussion, but the way that I like to frame it is that, and it's the same with anything prediction wise, right? Like we have no way to predict what the stock market will do. We have no way to predict what the bond market will do. And so because we're gambling when we're choosing, and when I actually pose this question to someone and they're making the decision, we'll break down really granularly the differences between everything. But the way I like to think about it is if I'm taking the gamble, which gamble would I rather be wrong with? Would I rather have a fixed rate and now rates have come down? Or would I rather have a variable rate and now interest rates have gone up? Emotionally, which one allows me to sleep better at night? That's the one we should put more weight under because the rest of it is all guesswork, right? We're just guessing, and some people might say they're good at guessing. I think track record shows that nobody's that good at guessing. You're either lucky at guessing or not.
Yes, yeah, exactly.
Yeah.
And of course,
Yeah.
there's the
So,
benefits. There are definitely benefits to paying off a mortgage, even if weekly or bi-weekly, because that just reduces the interest rate over the term of the mortgage, yeah, as well.
well, and actually here, and this is something the banks want everyone to focus on interest rates, right? As if interest
Mm,
rates are the most important thing, even though, like I just mentioned, we have no control over the interest
yeah,
rates and we don't know what interest rates are going to be. So in my opinion, they're an important variable in the calculation, but they're definitely not where we should spend most of our time. And in fact, the banks, and Minu, you know this because you were in the space, the banks are not making the money on the rate. The banks are making money on the time, right?
yes.
And so that's where we should spend most of our efforts on is how do we pay off the mortgage faster? And a really simple calculation or a simple example is if I take a 25-year mortgage and a 20-year mortgage, the amount of interest I spent on the 20-year mortgage would be the same as if I took a 25-year mortgage, but had 1% lower on the interest rate for the entire time of that mortgage. So instead of worrying about can I get zero point 0.1 or zero point 0.2 better, how do we structure the mortgage so that my cost, my interest expense is orders of magnitude lower, right? And the phrase that I like to say is that the goal is not to have the lowest rate. The goal is to spend the least in interest because the
Mm,
rate we have no control over.
yes,
Well,
correct.
Yeah.
I absolutely love that.
Yeah.
I like that. That is such a good visual concept as well, too. I want to actually throw a question in. Um, when you start looking, you're in Instagram or your LinkedIn, and you know how the algorithm starts showing you everything about mortgages or everything about whatever.
Yes.
Now, all of a
Yeah.
sudden, you'll start getting the feeds with how to pay off your mortgage in 5 years or less by adding one extra payment in a month or something like
Mhm.
that. Is that
Yeah.
a reality? Is that just what is it that we call that bait for you to click on to sending them your data? I don't know what that is. Clickbait, basically.
Well, it's both. It's both. I think you probably shouldn't get mortgage advice off of TikTok or
Yes.
Instagram Reels or whoever. But that being said, there are ways to structure the mortgage where you are making slightly larger payments at an increased frequency. So you can do what are called accelerated payments, and that will help us pay down the mortgage a little bit faster. Now, you won't pay down the mortgage in 5 years instead of 25 years, but you might be able to get that down to 22 years or 23 years instead of 25 years, which makes a big difference. And then this is something else that I have often as a conversation with people is that, and coming back to the gamble, right? If you think about your mortgage as a macro thing, right? We've got a 20 to 25 year horizon on this, right? Sometimes we're going to take a fixed rate and it will have been the right move. And sometimes we'll take a variable rate and it will have been the wrong move, right? So in the aggregate, we're just trying to be on average more right than we are wrong. But in that aggregate, there is some more gamifying, if you will, right? So, like, for example, we have a lot of mortgages that were done in 2023 when interest rates were quite a bit higher, right? So, all these clients that I've worked with who are in the 6% or the high fives, now their mortgages is coming up for renewal. And then we're playing this game where we're now comfortable with our mortgage payment. So we say, okay, let's keep the same mortgage payment, but now interest rates have come down. And so instead of owing, if we had taken a 25 year, we'd accelerated our payment, so it's now down to 23 years. And so 3 years later have gone by, maybe we're down to 20 years to pay off. Maybe by doing this little game, I said, well, maybe now we pay off the mortgage in 18 years, right? And if we're able to shave 3, 4, 5, 8 years off the mortgage through various things, whether it's prepayments, whether it's accelerating our payments, whether it's playing when the interest rates change, definitely that's where the strategy is most important. And that's where we're getting actual savings.
Very interesting. So, but Wayne, we want you to come back on screen because there is one more
Okay.
aspect of this. So, as an example, so Morgan was kind enough to say that we could probably maybe adjust some of our payments, let's say. He didn't say that exactly, but something like that. And I've noticed on some of the mortgages, you can actually put a lump sum of a certain amount at the end of the year. Okay. Is that a good tax move? So, I mean, you've got both sides of the coin here. Maybe you're saving money on your mortgage, but maybe you're not saving money on your taxes. I'm not sure. All right. And I know the answer will be it depends. But we'll get t-shirts made for all of us saying it
Yeah.
depends. Right.
Yeah, it depends. So yeah, I guess the reason it depends is because the interest component is tax deductible, right? So if your interest rate is 4%, just assume, 25% tax rate, the real rate of interest is 3% because you're getting a 1% deduction. So if you can get a much better return somewhere else, maybe paying down your mortgage doesn't make sense, right? And the reason it depends is sometimes people don't like having debt, right? They just don't want to have the debt. They're not comfortable with it. And so they prefer to do that method. So again, it's very case specific, but because the interest is tax deductible, but it also might not be. Like if you're in a loss position already, then you're losing some of that benefit. So that's where it depends again. So, but it's very specific on the person. If your net interest rate is 3%, you're getting a 7% return somewhere else, then it's best not to pay it off, I would think. But maybe you want to chat in about
Yes,
your thoughts on
actually, I
that.
was going to say this is something that I'm very passionate about. So
Yeah.
I do agree. I think what I would advise is that at the end of the day, you need to be able to sleep well at night, right? So that's the most important thing. Personally, I would much rather deploy my capital in a more efficient way. So if I'm able to get more returns by investing that money somewhere else, I'd much rather take the hit on the interest, right? Because I'm going to be earning a much higher rate of return investing somewhere else. And so that's me. So again, every situation is different, and the classic business school answer, it definitely depends on your situation, your peace of mind, what your goals are, what your objectives are. So I have some clients who have definitely come in to meet me with the, I want to pay down my mortgage, and then we start discussing. We start doing some illustrations on, what rate of return their capital could earn if it's deployed elsewhere, and then they walk away from that discussion with more information, and they may decide not to pay off that mortgage. But again, at the end of the day, it's all, you need to be able to sleep well at night, and that's most important.
Yeah.
Wow.
And if I
So,
can add a little counterfactual to this, because I have some examples of this, but so if anyone has ever watched Schitt's Creek, there's a famous scene where David is using all of the things as business expenses and they're write-offs, so they're free, right? And so sometimes people think, oh, I write off my interest, so it's like I'm not paying interest. You're still paying interest, right? It's still an
Yeah,
expense that is leaving your bank account and you're not getting back. And so saving money on interest is still better than paying interest. Obviously, the whole picture is required to make that assessment. And this is where I'm a big fan of the small incremental decisions we make on our mortgages because, and I had a client years ago who his financial advisor said, well, if you pay an extra $100 on your mortgage, you're going to save this much in interest. But if we invested that extra $100, you get this much on average return, and the return was much bigger. But then the question is, was that person going to deliberately make the additional $100 contribution towards their investments? Or were they going to find expenses in their week between restaurants and dinners and coffee, and they were going to spend it? And so where the structure of the mortgage, which is I'm a bigger fan of structuring the mortgage as opposed to making lump sum payments, is that we say, okay, well, maybe the payment's a couple $100 higher. It doesn't impact the rest of my investment strategy, but I now am also not, maybe when I go to the restaurant, I don't spend $150 on wine this week. I spend $100 on wine. That extra $50 is what I'm paying on my mortgage, right? So it's about finding that balance, right?
yeah.
so
Yeah.
from it depends to some amazing answers. I think the bottom line here, and I will let Minu close this up and you with your final comments as well. I think what the common denominator is here, you need really good professionals behind what your choices are. So thank you so much because I do nominate you as really good professionals. Okay, so you get the little seal of approval from the Canadian Business Council of Dubai and Northern Emirates. So from you allow us to get proper information to sleep at night, and you make it very layman friendly, which we appreciate that as well. So on that note, our time has come up. We could probably need a couple of other sessions on this, Manu. You might want to grab these two gentlemen and see if we should do something else along the way, because this will be part of our directory of very informative webinars, which people will probably go back to. So Manu, I will let you close up the session, and I want to thank you again from the bottom of our hearts. Take care.
Thank you so much, Morgan and Wayne. It was such a pleasure to have you both today. Morgan, thank you so much for, explaining in depth the nuances around a non-resident mortgage, and also for explaining the different lending options that clients have based on their unique employment circumstances. It's for a lot of us, we always question as to whether we can get a mortgage if we're non-resident. So it's great to see that it's possible, of course, with a certain tweaks. And, and I think you've set us up well to help us sort of start planning in advance. So really appreciate your insight on that. And Wayne, taxation. We're very grateful you're here because that is such a nuanced topic. So many gray areas, so many it depends. We're really grateful to have an expert such as yourself here to guide us through this process. I hope our members can get in touch with you. We will liaise with Diana on passing on contact information to those people who've attended. But really, really, thank you so much both for such an engaging discussion, and for taking me back to my very first career as well. It was lovely to host both of you. So thank you so much for your time.
Okay. Yeah. Thanks to all you as
Yes,
well.
our pleasure. Thank you.
Thanks, everyone.
Thank you. Thank you
Thank
so
you.
much. Have a good
Bye,
evening.
everyone. Take care. Have a
Bye.
nice evening.
Bye.
Bye.
Bye-bye.